Welcome to Buy, Hold, Sell. My name's Matthew Kidman, and today we're talking about small companies. And of course, we've just been through the annual profit reporting season. And if you think good things come in small packages, think again. The Australian All Ordinaries Index, or Small Ordinaries Index, is about the same place it was 12 years ago. But the good thing is we've got some of the best active investors in the world that operate in this space. And to join me to talk about it today is Dawn Cornelius from Colonial First State and David Allingham from Eli Griffiths. Start with you, David. Had a pretty horrible year in small caps. Seems to be coming good. Reporting season, tick of approval?
Look, still pretty tough out there, I think, Matthew. At the end of the day, it's tough to get organic growth in Australia. Interestingly, one stat I found interesting, JP Morgan provided the research, 32% of the small ordinaries effectively weren't listed 5 years ago. So just as a reminder, we're actually dealing with a lot of companies that haven't got a long track record, and I think that's adding to a bit of the volatility. Dawn,
we had a terrible period in small caps. A lot of money went out, probably from September last year to April, settled down, and the results, we saw the All Ordinaries, Small Ordinaries Index kick on. So how did you read the reporting season?
From my perspective, it appeared that short-term momentum was rewarded in this reporting season, but companies that were investing for long-term growth and sustainable competitive advantages were actually at a disadvantage and were actively sold down by the market. Companies exposed to infrastructure and perceived recovery in the mining capital expenditure boom did well as well, but as I said, companies that are investing for long-term growth were really marked down.
Well, let's go with that team. The mining services companies hated for years, 3 or 4 years, and then bang, and we're getting the same thing with infrastructure. Is that thematic still in the early stages, or have investors priced that in?
In some instances, there are companies that are obviously benefiting from a recovery in the mining segment, and for example, Seven Group through the Caterpillar franchise and through capital expenditure and usage of parts. But in terms of companies such as Monadelphous and Worley, they're still to deliver top-line growth, and margins are still under pressure. If you read their outlook statements, that feature's quite large. And also we've had a record mining capital boom. Whether we will repeat that and get back towards that level is questionable.
Okay, Dave, give us a sector that we can run off the back of the results that looks okay. Where would you like to position your portfolio going off the results?
Absolutely. Dawn's a great investor and I agree with her a lot of the time, but in this instance, Worley and Monadelphous for me are a great example of the kind of sectors you want to be in at the moment. Finding organic growth in Australia, parts of the economy that are actually growing is quite difficult. I think they're good examples of their earnings are troughing. Yes, PEs have expanded, but I think the future for those stocks over the next 1 or 2 years will be above earning basically market growth.
So you can stay in there.
I think so.
They'll have a lot of them are kicked hard, haven't they?
They've kicked hard. Look, they'll deliver above market growth as far as earnings per share growth, and I think they'll still see positive revisions. I think in the case of Monadelphous, the market's still 15% too low. So I think that quantitative upgrade cycle still to play out there. That's what's driven it from $3 to $12 and on to $15 now, and I think we'll see it higher in 6-12 months' time.
Let's go to the other end of the scale. What would you be avoiding at this stage?
Look, I think retail's still tough. I think any company that's got significant cost inflation, if you look at retailers, power, rents, you know, there are pressures there. There's wage pressures, even though it's not really being passed on to employers at the moment, and top line's getting squeezed as well, whether it's structural or just the way consumers are spending. So I think retail continues to be a difficult part of the market.
Okay, we get by on stock picking. Dawn, is there something, was there a result out there that impressed you during the reporting season?
Yes, for us, NextDC actually delivered an excellent result. It's obviously capitalising on companies and corporates going from on-premise data storage to off-premise data storage. And so they actually delivered an excellent result with very good operating cash flow and validated their business model, because there are significant capacity shortages within data centres that are third-party owned, and they also delivered an earnings result at the top end of their guidance.
Okay, what about the other end? Was something that disappointed you, where your heart sunk, your stomach felt bad when you saw the result?
Yeah, one in particular was Pact Group. Obviously for a company that is in a defensive sector like packaging, and they guided in early May. They actually downgraded in early May and they missed that downgraded number. For a defensive business, that was a very poor showing. They were exposed to the vitamin sector, which saw some significant destocking. In addition to that, they had some cyclical exposure to the dairy sector. New Zealand has recovered, but Australia continues to be under pressure, particularly given they have contracts with Murray Goulburn, where we've seen volumes come off significantly for them with respect to milk supply. So that was a disappointing result. However, the stock looks cheap versus Amcor and Aurora, so that was a very disappointing.
There. Okay, Dave, you get to sing for your supper as well now.
Okay, well, look, I think
quick good one, quick bad
quick
one.
good one. Can't go past Smart Group. You know, number was supposed to be 55 for the full year. They did 30 in the first half. I think that the market's upgraded numbers by 15%. I think it's going to be more like 20 when we get to the end of the year. Stock was $7, it's now $9. I think there's extraordinary quality there. On the downside, look, Main Pharma I thought was disappointing. They provided guidance, an updated downgrade effectively in early August and then missed that number when they reported their results. Working capital issues, poor cash flow. It's a very complex business. I think there's 150 million shares short by probably some of the smartest hedge funds out of the US who actually understand generics. I think the Aussie investor market's sort of been caught off guard there with the complexity of that generics business in the US, so we think that one's still an avoid.
It's a sector full of rocks, but if you look hard enough, there are some diamonds to be found.